Hello, everybody, and welcome. It's great to have you with us for this final lecture in our HLA Spring Webinars series. Thank you very much for joining us today. My name is David Pickersgill. I'm talking to you today from St. Louis, Missouri. It's great to have, as we always do, an international audience. And if you would like to put your location in your name, that's wonderful, just so we can get a little sense, a little flavor of where people are joining from. People are going to be joining over the next minute or so, and I'll give them time to do that. I'm joined today by Jakub of the Economics of Mutuality, who will be speaking to us today about that organization. It's great to have you. Welcome, good to see you. I don't know if you have been part of any of the other lectures in our series. I've really enjoyed participating in all of those, and so good to see you all. In a moment, I'll give a formal introduction to Jay, and then I will invite Michael Pearson to say a couple of words of welcome to you all. But wherever you are, whether you are at the beginning of the day or at the end of the day, it's really good to have you with us. Let me say a couple of words in introduction about Jay before I invite Michael, if he'd like to speak to us. Jakub is a leader in the Economics of Mutuality Alliance, which consists of two public benefit nonprofits, the Economics of Mutuality Foundation and the Human Flourishing Foundation, that own two for-profits, the Mutual Value Labs Consultancy and the Mutual Value Investments Private Equity Company, respectively. They're all headquartered in Geneva, Switzerland, but Jay is based in Washington, D.C. He's the author of the first Economics of Mutuality book, Completing Capitalism, Heal Business to Heal the World, and is a contributing co-author of Putting Purpose into Practice, the Economics of Mutuality. Jay spent 14 years working in the global headquarters of Mars Inc., the iconic family-owned, privately held chocolate and pet care company, where he helped the Mars Chief Economist lead the firm's internal think tank that created the EOM business model, management and investment innovation that is transforming business for the common good and is the basis for the Alliance. It's a pleasure to have Jay with us. And Michael, would you say a couple of words of welcome to Jay and to all of us at this point?
Well, yeah. Welcome, everybody. Good morning from New York. Jay, thank you so much for doing this. I'm looking forward to hearing more. And it's exciting to know that this is actually coming from practice. And I want to hear more in terms of how you're planning to expand this thinking, I think, by practicing it as almost like a private equity approach. So I'd love to see what's happening there. And thank you for joining us. Thank you, everybody else also.
My pleasure.
Thank you very much. Jay, over to you.
Great. Well, thank you very much, David and Michael. It's great to be here. And thanks for all of you taking some time out of your schedule to join this event today. I'm going to share my screen just so I can run through some slides to maybe make it a little bit easier as I frame this presentation for you. I'm going to talk, I think, for about maybe 20, 25 minutes, and then we'll go into some question and answer session. So Economics of Mutuality is this business model management innovation that's become an operating model that I'll talk about today. And I'm just going to give a couple of slides of context up front. One is just a kind of new slide that we started to use just to give a kind of an elevator speech as to what it is that this is all about, and then I'll get into the story behind it, and then talk a bit about how it works. And when we get into Q&A, if you want to talk about some specific cases of application and what's come from it, or we can move into the discussion about how we are introducing investments into all of this. I'm very happy to do that as well. So it is now it has grown up into an operating model, actually, that is really about putting measurable impact ahead of profit maximization. And when we do that, we're finding that through new business innovations and management practices and new metrics to cover non-financial forms of capital, which I'll explain in a moment, we're finding that actually we get a superior amount of holistic performance, but also financial performance with benefits for both the top and the bottom line, even in the short term. So we're finding when you do business the right way, when you put sort of purpose as a driver and impact that's measurable as really your way of working as you move forward, that you actually don't have to sacrifice your growth and earnings. You actually can perform better and more resiliently over time by being more responsible and contributing to the common good. We find that this is scalable. We've added significant digital tools as well to accelerate the deployment of what it is we've got when we work with corporations in particular. And by doing that, we're able to lower the time to deploy what we can bring to companies, but also reduce the costs so that we can start to appeal to SMEs as well as multinational corporations. So I'm just going to say a few words about context about stakeholder capitalism, because over the last decade or so, there's been a lot of talk about stakeholder capitalism, and like so many of these terms, terms of art, they start to take on a life of their own, and they start to become a bit gray, and they mean different things to different people. So when I talk about stakeholder capitalism and I kind of look at the space of stakeholder capitalism, I find it's sort of divided in two main quadrants. On the left-hand part of this quadrant is this kind of more traditional firm-centric approach to stakeholder capitalism, where it's really about how do we, as a company, look inwardly, internally at our activities, and how can we do less bad at a cost, and maybe improve in a small way the impact on people and planet, but really reduce the kind of damage that we may be doing through our business operations. And this is very important to do, but that's not what Economics of Mutuality is about. We're really more in the upper right-hand quadrant of this, where instead of being firm-centric, it's really externally focused, trying to figure out how companies can grasp the concept of why they're set up to solve problems of someone else. And rather than doing less bad at a cost, it's really trying to figure out, can we do more good, but at a profit, and in a way that can actually be scalable, given that scalability ultimately is what brings transformation to business. If you can't scale it, it's really difficult to be transformational. So that's kind of my snapshot of what this space looks like and the journey that companies are traveling on. And business model transformation is kind of what I'm going to talk about today. So where did this all start? This has actually been going on for a while now. I joined Mars just at the end of 2006, when and Mars Incorporated, if you're not aware, is a large multinational family-owned company. Mars is actually the name of the family. It's not named after the planet, and the Mars family owns all of it. And it's now grown to about a $46 billion company that employs almost 150,000 associates. So it's gotten quite large. And the Mars family has three branches to it, and one of the branches is led by a man named John Mars, who recently retired. And John had this really intriguing question that he asked his CEO back just as I was joining the company. And then the CEO gave it to the internal think tank to address, which I was helping the chief economist lead at the time. And he was asking, as a shareholder, what's the right level of profit for the company? And basically, the right level of profit under financial capitalism, a la Milton Friedman, has really been not a question that anyone asks if they're a shareholder, because it's just assumed that it's as much profit as you can possibly generate for your shareholders. But John had a different idea. His thought was, well, maybe there's an optimum level of profit above which the company would be taking too much out of the value chain and would set a destructive sort of dynamic of squeezing one stakeholder or one value chain partner, squeezing another, and this would somehow create a disequilibrium if the company was taking too much profit that would disadvantage the company in the end, but they would never know why or really see it. So we wondered, as we looked as an internal think tank at this problem way back then in late 2006, early 2007, we couldn't find anything in the management literature to give us a clue as to what had been done previously over the last 50 years of financial capitalism. It was as like the question had never been asked before. So we thought, well, is it a new question? And then we started to think way back historically, and we realized it's not a new question, actually. That King Solomon the Wise, back in, I think, 950 BC, he said, one may give freely and still his wealth will be increased, and another may keep back more than is right, but only comes to be in need. And when we came across this quote, we thought, okay, this is what is the right level of profit kind of story that started 3,000 years ago. So this is not a new question. It was just one that was lost in the rush to create as much financial capital as possible under the Milton Friedman Chicago School of Business Financial Capitalism 1.0. So this brings us to the question of purpose, which I'm going to talk about a bit as I frame Economics of Mutuality and how it works. And I like to use this line to get people focused on the fact that the purpose of business is actually not to create profit. Of course, it has to create profit to survive and thrive, but that's not the purpose of business. The purpose of business is really to deliver profitable solutions to the problems of people, place, and planet. And it's definitely not about profiting by creating problems for people, place, and planet. But unfortunately, many corporate leaders have have gotten lost on this journey of profitability, and they've started to think the purpose of their business is to make profit for their shareholders and to maximize that profit. And that really loses the whole sense of what a company is really designed to do. It's to solve these problems of people, place, and planet profitably. So I mentioned a little bit about the fact that there's one form of capital that's behind financial capital, one set of metrics. And in business, you only manage what you measure, right? You probably heard that phrase before. And so if you only have metrics, like you have in financial capitalism to manage financial capital, then basically you're limiting yourself in terms of your ability to access and mobilize and measure the other three forms of capital that are actually visible in the management literature and are very real. And there's a tremendous amount of inherent value in what we call human capital, social capital, and natural capital. So when we started this work now about 17 years ago, I guess it's been a while, when we were still inside Mars, we started with the metrics-based approach. The chief economist of the company was leading it, so it's not surprising that we would start with measurement. And we looked at how we could measure social, human, and natural capital with a small number of metrics in a way that was really scientifically robust enough, and simple enough, and stable enough, and standard enough for businesses to actually be able to make use of it with the same confidence that they would have in measuring financial capital. And we actually did crack this with a lot of help from academics and a lot of testing in the field. And we discovered actually there were only about 13 metrics in total that we could utilize to cover human, social, and natural capital. And in using those 13 metrics, we would have a confidence level of about 80% of accuracy of being able to understand, and when we were measuring what a social capital space looked like for business, natural capital, and human capital. So those became the building blocks of Economics of Mutuality. We started to think about how we can start to convince business to expand their definition of performance beyond one form of capital, financial capital, to include all four forms of capital. And this was aided by the discovery through our extensive field work that we did in those early years, the discovery that not only could we measure, manage, and mobilize these non-financial forms of value of capital, but actually there was a correlation relationship that then we were later able to prove was a causal relationship between how much you created or depleted of social, human, and natural capital in your business activity and your growth and earnings, your top and bottom line. And so basically, if companies were only managing a financial P&L, the profit and loss statement, without understanding really the dynamic of whether they were creating or depleting social, human, and natural capital, they were risking having a major invisible drag on their growth and earnings. But to flip that around, if they actually started to manage with intentionality and more purpose, growing social, human, and natural capital in their business activities rather than potentially depleting it, and then including that in their P&L, that actually they had a tremendous upside potential for their growth and earnings as well, that they didn't realize was even there. So these four capitals became the building blocks of Economics of Mutuality, and we can talk about that a little more later. So getting back to purpose, I love C.S. Lewis's quote, if you're familiar with him. He was an Oxford professor and then an author of some note later. But more than a century ago, he said, purpose is like a light, and you don't turn on a light in a dark room and then study the light. And I love this idea of purpose being like a light, because as we dug into the purpose statements of many, many multinational companies in our work, we discovered that most companies actually like to either frame purpose as a description of what they did, or as a value statement. And the value statement was really not something that you could action through strategy in the company. And it was done usually through external consultants. And then it was owned by your communications people, your corporate reputation people. And so really it was like trying to get the external world, your potential clients and customers, to look at the purpose of your company like a light and be inspired by it, but looking at the light itself, not at what the light illuminated, which was the third type of purpose statement that was very rare in businesses, but that we use as a critical central component of what we do, which is really to help companies and their business units frame their purpose to address a problem that someone else has. Okay, so that company is there to solve a problem externally, and that business activity needs to have a purpose statement that's actually framed that way. And when you do that, when you decenter the company and you actually start to look at the purpose, you start to see how the light of purpose illuminates the problems of stakeholders. And I'll get into that next. So when you think traditionally about business, and they look at their stakeholder ecosystem. Ecosystem is a word we really like, and it seems to be taking on more of an interest in companies. It's typically the same types of stakeholders in that ecosystem, no matter what kind of business activity it is or what kind of purpose statement it is. And that's because the firm centers itself and its profit in the middle of this ecosystem. And so you tend to get the same kind of results. And it's really very much about value extraction. So the company is trying to extract as much value from its ecosystem, keep it for itself, convert it into profit for its shareholders. It's overly simplistic, I know, but that's generally the way business thinking works. What we do with the economics of mutuality when we start to engage a business unit is we try to get the company to decenter itself and actually put purpose at the center. And being a historian by first training and love, myself, I tend to think about historical analogies, and it's almost like Nicholas Copernicus. If you remember, he was a 16th century astronomer in Europe who discovered that against the belief system at the time that the planets of the solar system didn't revolve around the Earth. They actually revolved around the sun. And once he decentered the Earth and put the sun at the center of the universe, then suddenly all the mathematics made sense. And I kind of feel like it's the same way with business. When you decenter the firm and profit from the ecosystem and you discover that its purpose, the sense of shared purpose, made actionable by making it a societal challenge that you're trying to solve, then suddenly you have the right lens through which you can populate the ecosystem with the right stakeholders that the business unit or the company needs to deliver the purpose that it says it's there to deliver. And so we kind of do that reframing, and I'll give you a couple of practical examples. This is a company we didn't work with, but they went through a very similar journey to companies that we do work with. And I love the example because it's so clean. Novo Nordisk is one of the biggest suppliers of insulin in the world. It's a Danish company. And for many years, they had this non-actionable descriptive purpose that wasn't very inspiring. It didn't differentiate them from their competitors, and it was to sell more insulin, basically to treat the symptoms of diabetes and to make money from that. So it really didn't differentiate them at all. And then they had kind of an epiphany years back, and they decided to create a societal challenge purpose. And they wanted to be in the business of insulin production to solve diabetes. And that would be treating the underlying cause of the disease to potentially eradicate it. So, in some ways, this is really counterintuitive because an insulin company that solves diabetes could be out of business. But nonetheless, this was a much more purpose-driven, actionable type of approach that radically differentiated not only the way they behaved as a company, but also the way they were perceived by their stakeholders in the ecosystem. And it wound up boosting their business significantly because the ecosystem of stakeholders wanted to work with Novo Nordisk over the competition because they realized that they were truly in it for the right reasons. So the way you frame your purpose to make it actionable actually can really radically transform the way your business operates and how it's perceived in the marketplace. Mars is a little more complex, and even though we work with them, they've got a business statement that's a purpose statement at the top corporate level that's more of a value statement. The world we want tomorrow starts with how we do business today. It could be inspiring, but it's a value, and it's not really actionable. But if you work down, Mars is known for M&Ms and Snickers and so forth, but actually 2/3 of its revenue is in the pet care space. So it's really a pet care and pet food and veterinary clinic type of company in many ways. And its segment purpose, it was also a value statement, a better world for pets. It's consistent with the corporate purpose at the top. But the business unit that we had done a lot of work with, which was called Royal Canin, about a $6 billion company that grows at double digits every year. So it's kind of the crown jewel in the portfolio of companies in the pet care segment of Mars. We helped them create a societal challenge statement that was actionable for their purpose. Was how do you improve the health of all cats and dogs? So that was kind of the beginnings of the journey that we took with Royal Canin. The next step that we do, and this is just a snapshot of an interactive stakeholder map that we put together for Royal Canin as a client. Again, this is a nutraceutical pet food company where the cost is quite high, but the nutritional value is also very, very high for the pets. And what we did was we took that purpose of improving the health of all cats and dogs. We used that as the lens to populate the ecosystem of the right stakeholders for Royal Canin to pay attention to if they're going to deliver that as the purpose of their business. And so it included things like healthcare providers, pet owners, breeders, retailers, behavioral veterinarians. I mean, there are lots of different stakeholders in that ecosystem, but we map them out And then we did something called mobile ethnography, which is another service that we provide our clients, where we basically, it's a fancy way of saying that we do clinical interviews of a subset of the key stakeholders to try to objectively surface what are the pain points that they're suffering from. So this is kind of a radical change for the way business starts to see its stakeholders in their ecosystem, whereas before they were looking at their stakeholders as how can they extract as much profit as they can from them, to how do we identify what they're suffering from? What are the obstacles that are in their pathway where they operate in such a way that these obstacles are impeding their performance in collectively contributing to delivering the purpose that they've been all brought together with Royal Canin to deliver? And so what you see on there, I don't expect you to read these because they're probably pretty small on your screen, but these are color-coded around a diagnostic of the different forms of capital I talked about before. So we use that to kind of identify the problems and what kind of solution would you actually need, what kind of intervention as a company to help solve the problem. So if you've got a problem that has to do, for example, with the breakdown of trust between the breeders and the veterinarians, that was a real major pain point. They didn't trust each other at all. They didn't like each other, so they didn't work with one another. And as a result of that pain point in the ecosystem of stakeholders, the performance of some of those key stakeholders was not what it should be in working with Royal Canin to get this done. So we identified that as a pain point. We used the diagnostic of social capital, which is measured by trust, social cohesiveness, and the capacity to work collectively. So really a trust breakdown is a social capital breakdown that needs a social capital intervention. And so then we helped Royal Canin design an intervention that would grow the trust, grow the social capital in a measurable way, and alleviate that pain point. There are other pain points that are similar to that had to do with a lack of well-being in the workplace of one or more of the stakeholders. So we helped them create an intervention to help resolve that pain point. Very kind of low-cost investments with a very high impact on the ecosystem. And you only really have to solve 2 or 3 key pain points that are obstacles to performance to actually create this effect in the ecosystem of stakeholders of a supercharged ecosystem that actually is delivering measurable performance benefits that are holistic in nature for impact, but also are impacting their top and bottom line. So you get a much more highly performing ecosystem of stakeholders when you operate in the way of kind of thinking about your neighbors and how you help your neighbors solve their problems and co-create value rather than just extract value from them. And it's every man for himself, so to speak. No, I'm just going to wrap this up in a couple of minutes because I want to make sure we get plenty of time for questions and discussions. But these are just some examples of sector level challenges that we've addressed. So these societal challenges I talked about before that we've worked with different companies. So we worked with one large Japanese company that to really reduce the emotional and social loneliness, actually, that turned out to be a key pain point and a challenge that was in their business ecosystem. We've worked with a number of large banks, actually, one in the UK and one in Singapore, and now a smaller one in Scandinavia, that to really help them increase financial inclusion and resilience and help banks start to think about their clientele, especially those who are not financially sound in their own economic situation, instead of just engaging them as potential customers to sell them more financial instruments, which is the way banks typically engage everyone who's banking at their bank, where we help them to actually look at the opportunity of acting like a financial counselor or a mentor to people that are less financially well off, but that are clients of the bank, to help them actually introduce much more sound management of their own finances so that they actually become healthier financially and more well-being, so that they become better customers of the bank and purchasers of financial instruments. So really thinking about the well-being first of how banks interact with their clients, rather than looking at just how much they can extract from them. So there's a lot of different areas in which we work across different sectors of the economy, and we work with probably about a dozen multinational corporations at the moment, and now we're starting to focus on some SME relationships as well as we've adjusted our model. I just wanted to throw this up quickly because this is something we did for this Royal Canin example I gave you. We This is an example of a multi-capital scorecard, actually, to track the performance of the company. And the way to look at this really is that companies tend to measure their performance really only through short-term financial returns, and they look at things like inputs, activities, and outputs, and that's what they use to measure their performance. But what we're introducing into the scorecard really is outcomes and impact, which is really how can we introduce these non-financial forms of metrics as leading indicators of long-term holistic value creation. And so getting companies like Royal Canin to start to think about outcomes and impact as well as inputs, activities, and outputs introduces these non-financial forms of capital, which actually can be leveraged to bring significant value. And so they're starting to use these dashboards as we go forward. And this is just a quick mock-up of what is called an ERP class dashboard for executives, so they could start to track the health of their ecosystem and their key stakeholders, in this case, veterinarians on the right, and to help understand where they are in terms of their job satisfaction, their human capital, their trust of the company that they work for example, their well-being in the workplace, the different forms of capital I talked about earlier. This is just I think it might be my last slide here in the opening presentation, which is really just, I wanted to give you a sense of some of the digital tools that we've been introducing to help speed up the delivery of economics of mutuality and reduce the cost as we go forward. So these are some different tools, and if there's more interest in this, I could speak to them individually later as we go. And this is really the end of my piece of the talk. So hopefully I've come in on time. But I used a quote from the Mars Pet Care segment just because we've had some real success with this Royal Canin crown jewel, and Loic Moutot, who is the president of that accounts for the business segment that accounts for about 2/3 of all the Mars revenue. He really said something powerful about economics of mutuality. As you can see there, driven by EOM, Royal Canin has become the sector's most valuable brand and the most successful Mars business, tallying 20 years of double-digit revenue growth. So that was a case where a company that was actually a business unit that was actually very healthy was coming to us, not one that was struggling, and looking at economics of mutuality as a way to become even better in the way that they work. So that's what we've got, and I think I'll probably leave it at there now and turn things over back to David to facilitate some questions.
Thank you. Thank you so much, Jay. Thank you. Very much appreciated. So the format of the balance of our time today, I'm going to spend about 10 minutes asking Jay some questions, including some of those from the chat. If you would like to propose a question, please do put it in the chat or thumbs up a question that has come from someone else. And then we'll have breakout sessions for about 10 minutes, so you'll get the chance to discuss with other people on this call and get to know them. And then finally, we'll have an open Q&A for the last few minutes of the session. Jay, I found that talk fascinating. Thank you so much for it. I have a question just to begin with. The model that you've proposed, this model measuring all these different kinds of capital, not just financial capital, is very attractive. Also, as you were running through it, it seemed to me to be quite complicated. So I imagine the proverbial person who sits in a room and invents a product, and then just says, well, are people buying my product? Yes or no? If they're buying it, I'm succeeding. If not, I'm failing. That's a really simple thing to get your head around. Could you speak to it? It seems like you might need to have you might need to put a lot of resources in. You might need to have a company that's got people that have the ability to work in this more complex way. But is that right? Am I seeing that right?
Well, it certainly has been challenging over the years to try to simplify the message so that we can do what it is that you're saying. But basically, what we're doing is we're taking companies that tend to work with one form of capital, and we're introducing them to rather simple ways through quantitative survey instruments to measure, manage, and then mobilize the three non-financial forms of capital that are available to them, and really understand how they're performing against these different forms of capital. And when you do that, actually you open the door to leveraging a significant amount of value that you had been squandering because you don't have the metrics without this kind of approach to capture the value of human, social, and natural capital, and to leverage it not only for your stakeholders now in your ecosystem, but also for your shareholders as well. So the performance of this, I think, will ultimately be the best selling point. And we're finding in many instances that you can deliver 2 times the retained earnings in a more resilient business, even in the same short-term way that companies tend to operate, by simply leveraging these different forms of capital that you hadn't used before. And becoming more purposeful, we also find is a way in which you can deliver more value that is measurable. So it's not sort of a hollow claim. There's a substantial casework that's now behind this. And so ultimately it either works or it doesn't. And I think just in closing on this question, if companies continue to operate the way that they've always operated, where the rules of the game have changed, I think in the financial capitalism world of Milton Friedman, over the last 55 years or so, the rules of the game were really about for the economy. It was really about financial capital creation and accumulation. And now there's so much capital, there's so much excess capital, financial capital in the global economy, that the rules of the game have shifted. And actually what people are looking for now is they want to have, through their social capital and their networks and so forth, the ability to access the information they need to do what it is that they want. And they don't have to buy everything. They just need to have the relationships there, the social capital, the trust of others to access what it is that they need. So if companies ignore the relative value of these non-financial forms of capital to the shrinking value of financial capital because it's in excess, it's going to really be at their peril as they go forward. But you do make a good point. It's not an easy thing to explain.
Thank you very much. And what I hear you saying is that the economics of mutuality isn't just saying this is something that this is a good idea, go off and do it. You've actually developed tools to enable people to be able to analyze that. Yeah, thank you.
We assumed the why in the beginning, and we started working on the how-to right from the
Yeah, thank you. So other question, kind of relating to that, there's a couple of questions in the chat about publishing this, because you've taken a very quantitative approach. I know there's a lot of people on this call who are lecturing, who are teaching within business schools, and they would love to be able to present the published research on this. And I know that Economics of Mutuality is working with the Academy as well. So could you say a little bit about the process of how you're publishing this research, how people can get access to things that they could use in the classroom?
Yeah, for almost 9 years, we actually had a very robust partnership with the Said Business School at Oxford University. So we collaborated there. We set up a lab. We created some curriculum, actually, and did some teaching of Economics of Mutuality there. We also taught at the Paris School of Economics, the Sciences Po Management School for 3 years. We taught a kind of shortened semester version of this. We've partnered with the China-Europe International Business School, CEBS, in Shanghai, right up till COVID, when COVID made it difficult to work there. So there was some teaching of this there, and a number of other universities as well. There have been some published academic work on this as well, which I think would be accessible through our website, eom.org. And if it's not, we can find a way to point you to it. So we've collaborated with many of our team, actually, that came out of Mars. We had doctorates across different subject areas, but good business acumen as well. So we could kind of bridge between the academics and the practical business application, and we could even co-author peer-reviewed type work. There's a couple of books that are out there that I can direct you to, the most recent of which was published by Oxford University Press in 2021, called Putting Purpose into Practice, The Economics of Mutuality. And there were about 30 co-authors. I was one of them as well. And that's more of a kind of how-to book. It's something that you can buy, of course, but you can get through our eom.org website a free link to download the whole thing as a PDF if you'd like to do it that way. There's also a book that I co-authored with the former chief economist of Mars on this topic, which is an introduction to economics and mutuality and the philosophy behind it, with some case material in it, called it's called Completing Capitalism, Heal Business to Heal the World. So there is publication on this, and we're growing that more and more as we get companies that we work with to agree to allow us to do case studies that could be made available to others. Some of them are sensitive about their data, so it takes a little longer, but we have an increasing number of case studies we're trying to make available.
Yeah, thank you. Thank you very much. And we will send out an email following this call to those who are on the call to be able to, that have got links to all those things in as well. Another question is coming about finance. And this question from Micah is asking about the role of banks in pushing this kind of movement forward, and the role of banks to be able to shape the way business is done. And I know that there's work with the Economics of Mutuality about investment more broadly than just banks as well. So I wonder if you'd say a little bit about that.
No, absolutely. We do have several banking clients. One of them is one of the largest banks in the UK, and another is one of the largest ones in Singapore. I think I mentioned that before. And now we're starting to work with an alliance of smaller banks across Scandinavia. And I shared just a little bit in the example, so I won't repeat it, of how we've started to work with banks. But banks are a real driving force in this space, and it's interesting because there's a bank in Singapore that wanted to repurpose themselves as the best bank, and as we started to engage some in their leadership, they got very interested in what it was we were doing, and they modified that to be the best bank in a better world. Which starts to take you a little bit more into the purpose that they're trying to put forward. The investment side of things, which I guess is related to this and part of your question, David, is really important to us as well, because we realized when we spun out from Mars in 2020, August of 2020, not the easiest time to spin out and try to create something new on your own, although we got a lot of help from Mars, right in the middle of the pre-vaccine COVID period. So it was a tough way to get started. But we realized actually that trying to transform companies through their business units, one company at a time, was a really slow process, and we needed to find a way to kind of increase the uptake and accelerate the uptake of what it is we're doing. So we realized the best way to do that is to become the GP, the general partner, in acquiring companies ourselves. And so we brought in as an overall leader a very rare kind of a person, somebody who came out of a theological background, interestingly, but then found that his gifting was in investing, and he was a private equity investor who created his own purpose-driven private equity company. I know that sounds very unusual, and it was, but his name is Gavin Long, and Gavin joined us about a little over a year ago, taking on the overall leadership role of the Economics of Mutuality, and coming in with a private equity kind of approach and wanting to adapt the learnings from Economics of Mutuality to transform the way financial capital is actually deployed in investing and make it much more transparent and measurable for the investor. So, if you think about the kinds of investing that take place today, there's traditional investing, which tends to do a lot of damage and extracts a lot of profit, and it's still the kind of predominant model. And then there's another kind of investing that's called impact investing, which tends to more maximize sort of the impact that investors are having, but it's really difficult to scale and often requires the investor to take less returns. ESG investing is starting to become something that people are talking a lot about. There's a lot of money behind it, but we're finding that ESG has a lot of metrics that are more about compliance than about value creation. So that's also a difficult sell as you move forward. What we're trying to do is really use Economics of Mutuality to optimize the investment capability and to actually use this transparent, measurable impact as a way to drive your investment behavior. And by so doing, we're starting to see signs that we can actually deliver more value than you could, or at least as much value as you could in traditional investing, in a way that's much more impactful and measurable. So we've acquired our first company, which is a mid-cap kind of a middle market healthcare advocacy company, an IT company outside of Washington, D.C. We raised capital to do that. We're the GP, and we're about to close a second acquisition on a second healthcare company. We're going to merge with the first, so it'll be about a 30 million EBITDA company, not small, when we get it going. And as the GP of both merged entities, we'll be able to really significantly transform its operating model and demonstrate how this investment approach works, and go deeper into companies than we've been able to do, going around the edges of people's operating models.
Thank you very much. And just one last question before we go to breakout rooms. There's been a couple of comments in the chat about trust and about human capital and about employee well-being. You spoke very eloquently about how this approach makes a difference in a firm's engagement with the outside world. Could you say a little bit about when a company starts on this kind of journey and seeing capital in this kind of way, what's the effect on the culture within the company and how employees of the company experience what it's like to work there?
That's a great question. When we look at social capital, we tend to focus on, where is the business activity taking place, and the communities that are involved or impacted by that business activity. When we look at human capital, that's very internal to the company. It's really about identifying what the true drivers of well-being are for your workforce, which are often determined by the culture of your company and the kinds of people that it attracts. And we find actually that whereas the trust, social cohesiveness, and capacity to work collectively metrics that together account for 80% of the social capital space pretty much apply everywhere and are very standardized. And similarly, the human capital metrics, we've kind of got 5 input metrics that are leading indicators that are the same however you apply it. With human capital, you have about 5 metrics that you care about, but they could be different depending on the culture of the company, because you don't know until you measure it, what those employees in that culture of that company really care about. So the methodology is standardized rather than the metrics for measuring human capital. And as an example, and the methodology we use is pretty simple actually, and uses data that's readily available and some survey instruments to plug the gaps in the data when that data is not available. But we were able to determine across all of the Mars units, for example, when we first started measuring the human capital, that something called walking the talk of the values that managers espouse was the number one driver of well-being across the whole company. So the culture of Mars was attracting people that really cared about, the principles of Mars that managers were spouting all the time, and they wanted to make sure that those managers were walking the talk and not behaving in different ways. And we discovered even that through this work that if you could meaningfully address and improve the confidence that the workforce had in their managers walking the talk of the values, that it was equivalent to a 30% pay increase that you didn't have to necessarily give. So the short of all this, I guess, is that when you can address human capital in a meaningful way, you can create interventions to drive up what matters to the workforce, really. Then and this methodology will enable you to do that. Then you start to get 3 benefits that are directly relevant to your performance as a company. One of those is talent attraction. The other is talent retention, because people want to work for and stay working for places that actually look after their vocation, that actually match in the way that they're behaving more of their values and ideals. And you also get an optimized performance. We're discovering that when people feel really motivated by their company's approach, by their purpose, by their values that they're actually living out, that they just perform at a higher level. So again, all these things are very interrelated with one another. So you don't have to trade profit to do some good for people and planet. You actually can create scalable solutions to grow all of those things and become more profitable and with greater growth.
Thank you so much. Thank you, Jay. Well, now it's come time for us to enable you to have some conversation with one another. I'm going to open some breakout rooms in a minute. Please do introduce yourselves if you are ready. Hello, welcome back. Welcome back, friends. Thank you. I hope that you enjoyed that. I always say at this point that it's a great pleasure for me to get to know people through the Humanistic Leadership Academy. So many wonderful people who are like-minded in wanting to make a world that works for 100% of humanity. And I hope you enjoy it all as well. And now's a time, just a couple of minutes for open comments or questions or Q&A. If you have a question that you'd like to ask of Jay, or you'd like to feedback what you spoke about in your breakout groups, please go ahead. We invite you to keep it brief. If you can keep it under a minute, your comments or questions, so we can have time for a few of those. But anyone's welcome to start. You're welcome to come off mute, raise your hand physically or digitally. You can go right ahead. Alessandro.
Thank you very much. In our group, we were talking about the possibility to apply this model to non-profit organizations, especially universities. So our question to Jay is, do you have that experience that you can share with us of maybe universities that they have lost the purpose?
I am so glad
how they do it.
I'm so glad you asked that question, Alejandro, because I neglected to mention what we do with universities. And one of my roles actually is executive director of our EOM Economics of Mutuality Foundation. And what we're doing is we're actually helping universities create their own Economics of Mutuality branded centers. So we have one now in Rotterdam at Erasmus Business School, which is called the Rotterdam Center for the Economics of Mutuality. I'm heading out to Seoul, Korea, to put on a Economics of Mutuality forum next month at Hanyang University. That's kind of the top business school in Korea, and we're going to sign an agreement to create a Asia EOM center there by the end of the year. That'll be mostly self-funded, but we'll be providing access to teaching material and practical expertise for teaching and so forth. We'll also be doing before the end of the year, we'll be setting up a Nordic EOM center with the Norwegian School of Economics in Bergen on the back of a forum we'll be doing there. And sometime in the fall, maybe in November, I may be actually going to Latin America, down to Chile, to work with a university business school there that has expressed interest in maybe having a forum that leads to creating an EOM branded center. So we're doing quite a lot of things with universities for sure, because we really feel like, you can do executive education, which we do. So we have courses available, but that's about unlearning to then open your mind to learn something new. Whereas if we can get to the university students, the MBAs, the management school folks, earlier the better. They're craving something other than what's out there, and we've got something that's teachable. We've got curriculum around it as well. So thank you.
Thank you very much. Others? I will say I think there's another question almost behind the question there, which is
Hey, David, if you don't mind, I think Micah had a question. He was kind of visually raising his
Micah,
hand.
yeah, go ahead. Sorry, I didn't see your hand up. Micah, you go ahead.
Yeah, so it's also a little bit in line with my initial question, Jay, on the role of the banks in this. So I'm within the Netherlands. So I'm looking at kind of this sector approach. As a bank, we also have a sector approach, sector expertise. So can you actually also put like purpose central within a sector, for instance? Like this is the thing we are all that's impacting all of the companies active in that sector. Did you have any kind of like experiences in that field?
In banking, beyond the ones I discussed?
Yeah, so identifying a purpose within a sector,
Yes.
and then the relationship how a bank can be of effect there.
Yeah, I mean, financial inclusion is an obvious one, obviously, for
I know that one. Yeah,
But we've developed a new tool that was just flashed up on the screen briefly when I showed you the digital tools we're developing. It's got a lousy name. We're going to change it. It's called Mutual Value Initiative, but it's quite an extraordinary tool that we're applying first to investing. That really is about using machine learning and AI and big data analytics to look at all of the data that's available in an industry and isolate within that industry. So we did this in healthcare, for example, before we embarked on our first investment. You know, what this tool enables us to do is to look at all of the totality of that data to parse out what are the voices that actually matter. So in the healthcare sector, it would be the patients, it would be the pharmaceutical companies, the healthcare providers, and the insurers, the lobbyists, the government regulators, all of those. When you have identified all the voices, then the tool will help you identify from all of that massive data, what are the societal challenges that are most important that actually are agreed upon by the voices that matter. And these usually run between 8 and 12 of these societal challenges, so to speak. And once we really understand what people care about in the sector, all the key stakeholders, then what we'll do is we'll do a targeted search on companies that are equipped to deal with maybe 3 or 4 of those 8 to 12 societal challenges. And then when we get into deep negotiations with a company and can actually get into their data room in exclusivity, then we can do a full due diligence on what can Economics of Mutuality bring to those capabilities that company has that makes them interesting to us, because they're looking at being able to meaningfully impact 3 or 4 of these challenges that are all agreed upon. And then that's the thesis that we take forward in deciding whether we buy the company or not. So yeah, we definitely do that. I don't know whether we've done that for the banking sector yet. We may have, but breaking down that sector, understanding the voices and understanding what challenges actually matter, that's something that we also want to release as part of the thought leadership that we want to bring out to the table to get other banks and other potential clients interested in what we're doing.
great.
Thank you very much. And then Ken, the last comment, the last question goes to you, please.
Yeah, thank you, Jay. So in our breakout group, we were talking about the imperative of timing, and so love this work. Speak to us a little bit about how long this takes. You mentioned getting into the data room with some exclusivity and then diving deep, and so Micah's question about whole sectors, but even a single organization. What's the timing to do this, given how important this is?
Well, thank you, Ken. I appreciate your question. So I take it we're talking more about how do we work with a business unit within a corporation, for example, or a company itself. One of the mistakes I think we made, just to be transparent, when we came out of Mars, is we thought end-to-end transformation of multinational corporations was what we should be doing, but trying to get a large multinational corporation to swallow something like this end-to-end is quite an ask, especially during an uncertain economic time with all the COVID and everything else. So that's part of the reason why we've been trying to reorient our strategy and our technical tools program so that we can actually appeal to SMEs as well as multinational business units within multinational corporations. But there's no easy answer to your question, Ken, because as we accelerate more of what we deliver, we also want to Instead of being a solution in search of a problem, we really want to understand the problem of the clients and then look at what it is that we can do for them to address that. So we want to meet the clients where they are, but we've been, again, significantly able to reduce the time frame of what we're doing, even to map out an ecosystem of stakeholders. For example, there was a time when the cost was quite high, and it would take us about 4 months to do something like that. Now we have it down to about 4 weeks at a much lower cost. So it just depends on what it is that a company would want us to do. We have a client in Europe, a new client that now wants us to put on an event for their strategy team in their multinational company, so that we can introduce to those who run strategy how we would bring purpose that can be executed as strategy into that company. So that's a relatively small time frame to be able to do that, and then that typically leads to a contract to do something else, and you go deeper and deeper.
Jay, thank you so much. Well, thank you all for being on this call today. Thank you for your engagement. I will just up in the chat, I've just put a link to our HLA Summer Conference there. If you would like to continue this conversation, that's a great opportunity, great way to do it. Jay, very, very grateful for your time, for everything you shared today. I will send out an email with more information. Just remains for me to say thank you very much and goodbye. Enjoy the rest of your days.
Thank you, everyone, for your time.